Hi all, welcome to this tutorial. In this tutorial, we are going to cover the benefits and limitations of ratio analysis. So in the previous discussion, we already covered about the different types of ratio analysis like liquidity ratios, profitability ratios, market ratio, activities ratios. So there are different types of ratios are there that's we already covered in the previous discussion. So in this today discussion, we are going to discuss about the advantage or limitations of ratio analysis. So there are a lot of advantages for the ratio analysis. That's the insight for the management into company's financial performance and other various types of performance, operational efficiency, liquidity positions. So the ratio analysis give an insight to management in all these categories like company's liquidity, profitability, operational effectiveness or efficiency, and its investment future potentials. At the same time, there are some limitations also for the ratio analysis, like it is depending on the historical data. As we know, the most of the ratio it is collecting data from the financial statement. The financial statement data are obviously it is historical in nature, and it's not considering the qualitative factors like the employee performance, brand growth, or any other non-economic or non-quantitative factors or qualitative factors which is not considering. So there are a lot of limitations also for the financial ratio analysis. So in this today discussion, we are going through this benefit or what are the advantages and what are the limitations for ratio analysis. So let's get started. Ratio analysis, as we know, it's a critical quantitative tool used to evaluate the relationship between various components of financial statement. Again, it is comparing various components of financial statement. It transforms data into meaningful intelligence, allowing management to assess the liquidity, solvency, profitability, and efficiency. This we already discussed in our previous lessons. It allowing management to transforming data into meaningful insights and allowing management to take various decisions. And it is giving an insight to management to assess what about the company's liquidity position, solvency position, profitability, and efficiency. So the primary benefit of the ratio analysis, first one, the simplification of complexity. As we know, financial statement can be overwhelming. The ratio considers hundreds of line items into single actionable figures like 2.1 or 2 is the current ratio. That means the current asset, or if you are taking one current asset or current liability at a point of time, it can be overwhelming. But if you are taking a current ratio, it can be simplified the effect how many times the company have current assets in the current assets of current when it's compared to current liability at a certain point of time. So it is first limitation of or the primary limitation of ratio analysis. It is the simplification of financial statements. The second thing, facilitation of benchmarking. Again, the financial statement analysis will help the companies to compare its performance against the industry benchmark or industry standard to see how the company is performing now. Again, if a company have two level of operation, just assume if a company is selling 100 ton, one company, and another company is just assume it is 500 ton. So in this case, the comparison like the profitability or current ratio or other comparison can be very effective if we take even if the activity level of activities are different. So the second advantage or primary advantage or benefit of ratio analysis is facilitation of benchmarking. It will facilitate the benchmarking company's performance against the standard. Then the operational efficiency tracking. We already discussed this like various activities ratios like inventory turnover or account receivable turnover will help the companies to assess the operational efficiency and the performance of the company and to make any corrective action if required. Again, the early warning signs. Ratio can be early warning signs before or it serves as a red flag. A declining interest or coverage ratio, for instance, warn a potential default long before a bankruptcy even occur. That means different ratios is one. If you are comparing a company's ratio analysis, just assume even the liquidity ratio over a period of time, if it is declining, the liquidity is declining, that is a sign of a one or is a early warning sign, is a red flag against the company's performance. So if you identify the red flag before it's occur, it can be a warning sign or a warning system for the company. Then the goal setting and performance evaluation. Again, management can use key ratios like different type of activities ratios as KPI, key performance indicators, to measure the performance of the company. The KPIs, as we know, or to evaluate the performance, there should be some measurable metrics in place. So the ratios can be a good KPIs or the measurable metrics to evaluate company's performance and setting and performance evaluation. So this can be some simple advantage or primary benefit why we are using ratio analysis. So let's move into its primary limitations. Even there are some limitations also for the ratio analysis. The first one is accounting limitations. As we know, for the ratio calculation, we are taking primary data from the financial statements. The financial statement have a lot of accounting limitation itself. There are a lot of limitation. The key limitation is historical cost bias. That means the financial ratio analysis is historical based. It is not telling about nothing about the future, but it's all about past performance or historical performance. There are the expected changes or no other non-qualitative factors which is not considering in the financial statement. So that itself a limitation for ratio analysis. Then the choice of accounting policies. In the accounting, there are a lot of policies related to accounting or policies, or there are a lot of choices for the management. Just assume for inventory valuation techniques or depreciation method, this can be choices to the management, or different management can decide different methods on all these practices like inventory valuation method or the depreciation valuation method. So if you are comparing both companies or two companies, this can be a limitation for ratio analysis. Suppose one company using a different accounting method or accounting policy than the other company, so that may not be 100% accurate apple to apple comparison. So that is a limitation of financial ratio analysis. Then the use of estimate. In the accounting itself, as we know, there are a lot of estimates we are using, like provision for bad debt, warranty reserve, salvage value. All these are estimates. So that is an actual limitation for the financial statement analysis itself. So if we are depending the financial statement for financial ratio analysis, so this limitation can affect the reliability of financial ratios as well. So the first category of limitation, that is accounting limitation, that all the accounting limitation which can affect the financial ratio analysis as well, because for the financial ratio calculation, we are taking the figures from the financial statement. So these financial statements have its own limitation. So this limitation can affect the financial ratio analysis as well. Then the structure and timing issue. The second category of limitation is structure and timing issue. Just assume if you are taking one value from the balance sheet and another value from the income statement. As we know, the balance sheet is a statement which is showing a company's position at a point of time, but the income statement, it is showing the company's performance over a period of time. So there is a timing issue or point in time nature. So that can be affect the performance, because one value we are taking from the income statement and another value if you are taking from the balance sheet, so it can affect the timing point in time in nature. The other thing, again, it's a point time in nature. If you are taking a balance sheet ratio or balance sheet value at a certain point of time, just assuming a current ratio measured on December 31st represent only one day, current ratio only for that single day. If a company pays of large debt on December 30th just to clean up the books, the ratio is misleading. That means if you are taking one value from the balance sheet, that ratio is particularly applied for on that specific point of time. If it cannot be 100% accurate if you are taking the whole year or whole period. Then the seasonality. Your retail's inventory turnover will look drastically different in October versus January. Annual average are necessarily, but often mask these fluctuations. Then even the inventory. If you are taking inventory on some seasonal period, definitely the inventory value will be higher, and in the off season period it will be lower. Even if you are taking inventory on a specific period on a season time, and if you are comparing that with use to some ratio analysis, it may not reflect the complete whole year performance of the company. Then the conglomerate distortion. For a diversified company, average ratios are meaningless. A firm that does both software and heavy manufacture cannot compare with the pure play software indication. That is, we cannot compare directly one company to another company without considering its operational structure and its company's policies, and its own policies and procedures can also affect the ratio analysis, like its own inventory level ratios or its own receivables ratios can affect the performance of the ratios, different ratios. So without considering this, we cannot directly take the number and directly compare with another company or another industry. So this is a structural and timing issue difference. Then the window dressing. Window dressing mean management. It's a practice that management trying to keep the financial records as more attractive. Suppose even that is 100% legal, but they're trying to manipulate to improve ratio before reporting dates, like delaying some purchases and the aggressive revenue recognition and sale lease back transaction. Like if a revenue center performance is measuring by revenue, the management may try to aggressive revenue generation to boost the profitability and turnover ratio over a period of time, but it may not be 100% accurate if you are considering a whole year performance. Then the management can delay the purchasing to keep the cash balances are high and to keep the inventory ratios are attractive. Then the sales and sales leaseback transaction, that can be to remove debt from the balance sheet and improve the leverage ratios. That means the window dressing is a practice that is management is trying to keep the financial ratios and financial statement more attractive in front of the investor or in front of the board or top management. So this can be mislead. Sometimes this can be mislead the management or the ratio analysis if you are considering window dressing, because it may not be 100% reflecting its operational reality. Sometimes it is a temporary attraction only. It may be in the next period it can reverse as well. So this can be a limitation for the ratio analysis. Once we are doing the ratio analysis, this has to be considered. That means we have to check, is there any window dressing opportunity is there, or this window dressing is happened in this case or not. Then the isolation trap. Isolation trap means if a single ratio cannot provide a complete picture of the performance. That means a high current ratio may look good, but it's often driven by obsolete inventory that cannot sold. Company is actually in trouble. Suppose if you are looking only into current ratio, the current ratio can be better if we have some obsolete inventory or non-moving stock in the inventory. But this is not a 100% accurate performance, because this is an isolation trap actually. If the company is focusing only on the current ratio, this can happen. But this current ratio is not reflecting the actual performance of the company, because there are a lot of current asset in this list that which have obsoleted, or which can have which is very slow moving, so which is not at 100% reflecting the real current asset in the company. Then the qualitative blind spot. As we know, there are a lot of qualitative effect like the management quality, market share and brand loyalty, employee morale. All these are very important to decide the future of the company. But in the current ratio analysis, we are not considering any of these qualitative factors, because it is purely quantitative factors only we are considering in the ratio analysis. We are not considering any of the qualitative factors, so this can be a limitation to ratio analysis. So we just look into this table to see the strategic benefits and limitations of some of the key categories, like the comparability. The comparability is can be a strategic benefit if we standardize result across different sized firm. If you want to compare two different sized firm, so the ratio analysis can be very effective, because when it's come to profitability, when it's come to different type of profitability and the inventory turnovers or even the liquidity activities, all these can be compared very effectively, even if the two sized companies or different sized firms. But if you're comparing, there can be disordered by differing accounting methods. Like if both companies are using a different accounting method or inventory valuation, like inventory valuation, if one company following LIFO and another company is following FIFO, this comparison may not be 100% meaningful. Then the forecasting. In the view of forecasting, the aspects of forecasting, the the benefit is identifying trend for future budgeting. Even if you are following if you are comparing financial ratios of different period, which will give an outlook of how it will be in the future. Again, that's the limitation is that the past performance do not guarantee the future results. The past performance, it cannot 100% guarantee the future results. So this factors has to be considered, or this can be a limitation for the forecasting. So in the aspects of risk, highlight solvency and liquidity risks. Even if we are considering the risk, the in the aspects of risk, if you are looking in the aspects of risk, the strategic benefit of ratio analysis is it to highlight the solvency and other liquidity risk in advance. Again, the limitation for that like window dressing and timing manipulation can mislead the ratios and mislead the management decision as well. Then when it's come to efficiency aspects, it measures how well assets are generated revenue. That's a benefit for the ratio analysis. Then it's ignore the inflation and current market value of asset. That's a critical limitations in terms of efficiency. So to overcome this, so we notified that there are a lot of limitation for the financial ratio analysis. So if we are doing a financial ratio analysis, we should overcome this limitation. So there must be some discipline has to be followed by the analysis to overcome these benefits. So sorry, to overcome these limitations. The first one, it should be read footnote. That means footnote are the note which is with the financial statement, which giving as a identify the accounting policies used to ensure the apply to apple comparison. That means footnote will describe, or if it describe the accounting policies used, or is there any off balance sheet financing used by the companies. So all these things will notify in the footnote. So if you are making before making a ratio analysis, we should read the footnote to see is there any accounting policies changes if you are comparing with another company. Then use common size statement. Like vertical analysis will help for will make the comparison more easily if you are comparing two companies which have two operational level or two different sized companies. Then the adjust for non-recurring items. Remove one-time gain and losses to see the true operational rate. That means if a company have a non-recurring revenue, it should not consider for the analysis purpose or the performance analysis purpose, because it is not recurring, and it is not maybe it is not from the company's regular activities. So this has to be removed or adjusted before we making a financial statement or financial ratio analysis. Again, triangle with the cash flow. That means if you are seeing a big sales in the income statement, it should come as cash flow in the operating cash flow in the cash flow statement. If it is not coming, there are some issue with that sales. That means it may not be 100% sales, or there could be some quality issue with that customers. So these factors has to be considered. If the sales increase, the proportionally the cash collection also has to be increased. So we have to check if for a particular period the sales has increased. So what we can cross check simply, we have to check the cash flow from the operating activity to see which is reflected in the cash flow statement as well. So as a conclusion, ratio is just a starting point. It's not a destination. It tells what happened but require a professional judgment and qualitative investigation to understand why it's happened. Again, there are a lot of limitations. Ratio is a very effective tool to compare the financial statement, to assess the performance, to see the different aspects of a company's performance like liquidity, profitability, and solvency. Again, there are some limitations also. So we have to consider, or we have to think in mind about this limitation before doing a financial ratio analysis, and before concluding or making a professional judgment. So this is about today's discussion. So if you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. As normal, I am attaching this PDF material along with this video. You can download and use this material. Thank you for watching this video.